The news from across the pond has been absorbed here in the United States with a certain bemused detachment. British Conservative MPs are calling for a review of the Bank of England's independence and operational mandate after a series of missteps and policy bungles. From this side of the Atlantic, one could be forgiven for raising a quizzical eyebrow at the whole affair. After all, aren't we the ones who fought the Revolutionary War to shrug off the yoke of British rule? Isn't the entire basis of the American experiment a rejection of parliamentary oversight and a wholehearted embrace of democratic rule, for the people, by the people? In that light, the grumblings of Tory backbenchers about the inability of elected officials to steer the actions of central bankers starts to sound more like our founding fathers turning in their graves. And yet, as I've spent time ruminating on this controversy simmering in the UK, I've begun to detect the baying of a much larger ideological hound in the mist. The clamor across the pond doesn't represent merely a parochial power struggle between politicians and unelected technocrats, but speaks to a broader rethink of the past half-century's economic orthodoxy, one that Americans would be wise to take heed of. We are living in an era of resurgent democratic demand, of electorates the world over insisting that their expressed priorities be reflected in policies that shape their lived realities. From Bratislava to Birmingham to Boise, the people are saying enough to governance by pure expert consensus and the cult of credential worship. They want a true voice, exerted through their elected representatives, over matters as crucial as the cost of borrowing money or the destiny of their national economies. Against that backdrop, the Bank of England controversy looks less like an isolated skirmish and more like the opening salvo in a worldwide renegotiation of the social contract between governed and governors. How much authority should the people's ambassadors in Parliament hold over monetary policy? How explicitly should democratic input flow into the technocratic mechanics of economic stewardship? Is there a balance to be struck between expertise and popular sovereignty? These aren't just interesting theoretical questions to ponder over sherry in the faculty lounge. The stakes involved are as substantial as they are concrete. Get the balance wrong, and you risk either ham-fisted political meddling that sends bond markets into panic spasms, or an acceleration down the path of elite-driven governance so removed from the public's priorities that it renders the entire notion of self-rule farcical. To find that elusive equilibrium point, we would be wise to revisit the conceptual underpinnings that granted bureaucratic autonomy such sweeping purchase in the first place. How did we as a society become so deferential to the edicts of opaque institutions like central banks, cloaked in the veil of apolitical impartiality yet exercising tremendous discretion over core matters of economic existence? The logic, in brief, went something like this: effective stewardship of the macroeconomic ecosystem required a technocratic remove from the push and pull of political horse trading. The public's expressed preferences may blow hot and cold, careening with the vicissitudes of the political cycle. Skilled experts insulated from those whims, with a singular focus on lofty mandates like maintaining stable prices and maximizing employment, could better navigate the turbulent economic waters with steady hands on the tiller. When that idea first took intellectual root in the waning years of the Bretton Woods system convulsed by the stagflationary 1970s, it carried an intuitive appeal. Who, after all, wouldn't prefer their economic chariot be driven by the sober, judicious hands of wisdom and learning rather than the sweaty grip of partisan rancor and special interests? Reposing monetary stewardship with independent mandarins pledged solely to the sanctity of various aggregated metrics just felt so competent, so rational, so modern. And for a time it worked. Through the 1980s and 1990s, the credentialed overseers of financial systems across the developed world leveraged their policy tools to largely keep the economy humming within acceptable parameters. Prices remained stable, jobs plentiful, and any short-term dislocations triggered by overheating or slack were swiftly corrected by a judicious application of interest rate adjustments. The temple of central banking became a sanctuary of technocratic excellence. The early 21st century, however, brought successive shocks that strained this governing framework to its core. An inflection point arrived with the ructions of the 2008 financial crisis, an earthquake that ruptured the foundations of the very financial system central bankers had been tasked with preserving. As the economy convulsed, the doctrinaire verities of central bank practice proved deeply inadequate to the moment's challenges. Responding with desperation improvisation, central banks began drastically expanding their balance sheets, conjuring new asset purchasing facilities from thin air and dragging down interest rates to historic zeros. Policy entrepreneurialism born of sheer pragmatism birthed a new economic paradigm. Mandates once laser-focused on sound money and full employment began their creep into murkier political thickets. Societal prioritization of national priorities like reducing inequality, greening industry, promoting diversity, and reviving depressed regions all fell under the vaulted purview of major central banks' revised policy frameworks. So expansive did this mission sprawl become that the Federal Reserve's 2019 Strategic Review identified aspects of its remit as the prosperity of households and communities rendered in broad-based and inclusive terms. Previously cloistered desk jockeys in the temples of high finance found themselves forced to weigh in on a dizzying array of knotty political conundrums far afield from the relatively pristine plane on which they'd ostensibly been consecrated to operate. Perhaps anticipating the conceptual turbulence and backlash to come, members of the central banking priesthood began making rhetorical overtures to democratic accountability. Fed Chair Jerome Powell insisted that while technocratic independence was vital for achieving economic stability, the institution lacks the kind of democratic legitimacy required to promote a greener economy or to ensure fuller social inclusion. Powell's European counterpart Christine Lagarde displayed a knack for the pithy soundbite, musing that we are not an elected, democratically legitimate body while hastening to claim that the central bank has to become itself diverse, has to embrace the societal changes and transformations taking place, because it is by doing so that it will preserve its legitimacy. But try as they might to redrape central banking in democratic fig leaves, the underlying reality remained one of self-professed philosopher kings operating in rarefied precincts of discretion, wholly detached from public input. Their only true accountability was to the edicts of economic scripture and the career incentives instilled at elite institutions of economic formation. Little wonder, then, that as the 2020s dawned with viral outbreaks, supply chain paralyses, geopolitical aftershocks, and broader social upheaval, significant portions of the public came to view the central banking monolith as insulated, aloof, and misaligned with their tangible priorities. Cracks in the veneer of democratic acquiescence began fissuring into chasms. When the UK's Tory critics call for a review of the Bank of England's independence, they aren't merely settling petty scores or agitating for partisan gain. They are placing a marker, sparking a long-overdue debate on the existential matter of where economic stewardship aligns in society's burden-sharing scheme of public responsibilities. The economic technocrats failed to prevent the 2008 crisis, their policy interventions post-crisis strained against traditional guardrails, and their claim to democratic accountability grew strained as their briefs inflated to include large swaths of social policy. At a certain point, the public's willingness to impassively submit to edicts of credentialed cabals anointed by meritocratic self-perpetuation needed to be re-examined. If central bankers are to indefinitely retain their privileged position as custodians of the economic commons, they must re-earn that public trust. Simply asserting that monetary decisions require insulation from the push and pull of politics no longer passes democratic muster when those decisions determine the prosperity and suffering fates of broad swaths of the populace. Evolving standards of legitimacy demand the establishment of new procedural norms that enshrine pathways for popular agency over economic decision-making, perhaps enshrining a more formal legislative approval process for central bank leadership appointments, or creating parliamentary review boards to monitor policy regimes against specified social outcome metrics. Maybe even exploring more direct democratic input mechanisms like public referendum and opinion polling as advisory inputs into policy formulation. These are not outlandish proposals from the radical fringes, but very much vital considerations if entrenched institutions wish to maintain their privileged status in the 21st century's democratizing landscape. Failure to proactively initiate this reappraisal and rebalancing from within could precipitate an external rupture far less controlled and amenable to compromise. Already, across the global economic landscape, pressures are building. In the United States, new intellectual frameworks for governing the economy that bypass the central banking monolith entirely are gaining currency across ideological spectrums. On the populist right, a growing national conservative movement has embraced a new policy vision it calls productive pluralism that aims to distribute investment and restore industrial capacity in a more geographically dispersed manner to revive heartland communities ravaged by deindustrialization and secular economic neglect. Freed from rigid allegiance to traditional metrics like inflation rates or output gaps, a productive pluralist approach to economic management consciously prioritizes maximizing the quality and dignity of work opportunities over pure efficiency calculations, resurrecting regional manufacturing nodes, reinvigorating small business ecosystems, and providing communities a renewed stake in their economic destiny all take precedence over scoring high on econometric abstractions. Meanwhile, from the progressive left, policy thinkers are reviving and refining philosophical schools of thought around democratic scorecards for economic rights. Economic policy formulation and evaluation would no longer revolve exclusively around arcane data points like the Consumer Price Index, but against a comprehensive dashboard of metrics reflecting concrete public priorities, housing and healthcare affordability, childhood poverty rates, racial and gender pay equity gaps, environmental quality metrics, and even indices of self-reported personal satisfaction and fulfillment. Rather than imposing a regime of top-down technocratic economic sovereignty, this vision enlists the public in crowdsourcing the very definition of economic success against which policy is measured. Localized town halls or digital democracy platforms could be leveraged to gather continuing input from citizens on which economic indicators most impact their daily lived experiences and quality of life. Both the productive pluralists and economic scorecard democracies represent profound paradigm shifts from the modern cult of central bank deification. Each proffers an alternative path back towards actual economic sovereignty, harnessing the mechanics of resource allocation towards the authentic advancement of human flourishing as defined by the public themselves. These divergent schools of populist economic thought do share one unifying thread, an acute distrust of entrenched, remote citadels of credentialed privilege dictating policy towards indifferent abstractions. The public is increasingly signaling that it desires substantive voice, not just rhetorical lip service from its economic governing institutions. The Bank of England's sage merely represents the vanguard wave of this swelling democratic tide. At their core, these rumblings speak to the human craving for agency over the systems and structures that exert such formidable influence in shaping our lived experiences. They reflect a public no longer content to impassively receive edicts whispered down from disciplinary high priests, but starving to participate as co-authors in the authoring of the economic scripts by which they're collectively narrated. Our economic discourse has reached a dramatic inflection point. On one side stretches the path of escalating popular revolt and uprisings against institutions perceived as democratically unmoored and deaf to public sentiment. On the other lies the road of proactive reform and inclusive reappraisal of governing frameworks to harmonize democratically derived purpose with technical administration. Those managing the economic machinery would be wise to heed Winston Churchill's admonition, "There is nothing wrong with change, if it is in the right direction." To improve is to change, so to be perfect is to have changed often. Rather than reflexively dismissing calls for structural economic reassessment as political blasphemy, the mandarins anchoring the current system would be better served leaning into these gale winds of history before they mature into existentially disruptive storms. After all, an economic system's core institutional architecture derives its legitimacy not merely from credentials or titles, but ultimately from the public's vested belief that it remains aligned with their collective pursuit of prosperity and flourishing. Strip that delicate wellspring of democratic fealty, and no amount of expert appendages and academic honorariums will suffice to keep the machinery operating indefinitely. So as the Bank of England increasingly finds itself thrust into the ideological tumult, let us recognize that this debate embodies something far grander than mere partisan squabbling over monetary levers and fiscal technicalities. No, what's afoot here speaks to humanity's age-old wrestle to yoke the cold mechanics of economic governance to its abiding spirit of participatory democracy and self-determination. Do we resign ourselves as pliant subjects to an economic regime ordained by a cabal of philosopher kings, claiming superior stewardship over the greater good? Or do we join together to reimagine innovative frameworks allowing for more direct exercises of public economic sovereignty? The crucible of history stands poised. The dog is barking. Now we must decide if we'll answer its call.